Dear friends, welcome to the February edition of Monthly Viewpoints. With the budget and global volatility, it seems like January was way back, but it was just a few days back. So let's come to the volatility at a later point in time. But to start with January alone, we have seen that the FPIs have put in money into the markets, especially the ETFs have pumped in money to the tune of almost $2 billion. On the counter side of things, the domestic investors were net sellers at $140 million, whereas mutual funds were net buyers at around $786 million, which they continue to do so for many months now. As a result of the ETF flows, we have seen that the large cap index has outperformed the broader market as such. The large cap index was up 4.6%, whereas the mid cap and small cap index were down 1.6% and 3% respectively, as indicated by the NSE indices. After a long time, IT has come out of its hiatus, and there was a broad-based buying which was seen in IT companies both in large cap space as well as the mid cap space. As the dollar index fell, the flows into emerging markets increased, and the monthly flows are making a multi-year high. That's the reason why we have seen that the emerging markets have zoomed. India has also done well, but it has not outperformed the emerging market. In terms of commodities, because commodities are inversely correlated to dollar index, Brent Crude was up 1.9% and gold was up 3.1%. The other commodities which had a rally early on corrected 2 to 6%. Those are aluminium, copper and steel. On the data front, the December CPI came in at 5.2%, which was 30 basis points greater than the previous month at the back of base effect as well as some bit of core inflation going up. On the other hand, the surprise was with WPI, which came in at 3.6%, which was 30 basis points lower than the previous month. The IP data came in at 8.4%, and if you adjust for one odd components, you would see that the IP data is still up 6%. The news on the GDP front was strong. The CSO has maintained its trajectory of growth for FY18 to be at 6.5%. IMF and Economic Survey have projected growth for next year to be at 7% plus kind of handle, which are good news for the economy as such. On the policy front, government has allocated 88,000 crores, which is the first tranche of recapitalization promise which they have made earlier, and this money will be well spent by banks to reset their balance sheets for both writing off NPAs as well as growth capital. In terms of trade deficit, it has widened, which is a cause of concern, to about $14.9 billion, where the exports have grown up by 12%, but whereas the imports have actually gone up by 21%. We need to have a close watch on the trade deficit as we go forward. On the global front, the data points across the world are positive. If you look at the Europe PMI numbers, they're at multi-year high. The unemployment number in US has been all-time low. The non-farm payroll number of 200,000 plus is the run rate which is going on. So the good data points, markets are correlating to be increasing rates by Fed, which is causing concern for equity markets per se, and that is transferring to the other regions and other equity markets as such. The union budget which was presented recently has been both prudent as well as credible. In a pre-election year where expectation was that it's going to be more populist in nature, I think government has stuck to the fiscal stance with the promise it has made in the last few years. We also see that it is growth positive because of the kind of impetus which it's giving on rural as well as small businesses. And there are budgetary spending as well as extra budgetary spending which is put in infrastructure, particularly roads and railways. As expected, the long-term capital gains was put in this budget on equity and equity-oriented funds. So there is reason for you to revisit your portfolios, maybe along with your financial advisor, to see how do you rebalance your portfolios and are you present in the right funds and the right plans. As government has grandfathered all capital gains until 31st of January 2018, there is no compelling reason for you to sell going forward. On the earnings front, we have seen that 2/3 of the companies of Nifty 50 companies have beaten estimates or are in line with estimates. So our projection of FY18 numbers to be at 10%, FY19 numbers at 19% seem to be on track. On the view of 50 markets, the first week of February has proven a point saying that equity markets will undergo volatility. There are corrections which would come, unlike in 2017 where it was a one-side move. There are corrections which we have to face and move forward. There will be a tussle between good macro data points, good growth numbers versus what the Fed would raise in terms of rate hikes. There would be a tussle between good micro corporate earnings versus weakening macro but yet comforting macro. There will be a tussle between political continuity and general rhetoric which would come before state elections. There will be such kind of news which will come, And as investors, as we are focused on our long-term goals, we have to stick with our funds and investments to work for them. The medium-term story and long-term story of India still is intact. There is no reason to worry. We just have to make volatility as a friend, and in fact participate in volatility in terms of hastening your investments or putting in lump sums during that point in time whenever such opportunity is presented to you. If your return expectations are 12 to 13% over the next 3 to 5 years time frame, I think it's a reasonable expectation one could have from the markets as well as from the funds perspective. So we have a whole host of basket available. If you want to play the large caps, you could come to our frontline equity fund or top 100 fund. You could choose our multi-cap funds in the name of equity fund or advantage fund. If you want to look at low volatility products, we have a balanced advantage fund which is based on the PE model. We have balanced 95 fund which is a hybrid model. If you're looking at the ELS scheme, we have tax relief 96. So there's a whole host of equity products which are available, and our RMs at the ground level would be capable enough to help you out in deciding which ones to choose. In terms of debt markets, the recent MPC committee has put the rates on hold. In fact, they were less hawkish than what the market expected them to be, and hence you see that some of the bond yields have rallied at the back of that. The inflation trajectory is above 4% at this point in time according to the estimates, but seems like the targeting at 4% is no longer there, and they're okay with a little breach of that particular number, which is comforting for the debt markets where the term spread is pretty high with respect to the repo rate. And hence, as investors, you would have to look at, let's say, if you want to ride over the volatility. But apart from a duration funds, we have the accrual funds, short-term opportunities for short-term in nature. We have our corporate bond fund and medium-term plan if you're looking at low volatility at a longer time period investments kind of scenario. Great. See you next month. Happy investing. Thank you.